Good morning. Welcome back to the Money Advantage podcast. This is Rachel Marshall, my co-host, Bruce Wayner, and special guest today, David Stearns. So for the risk of not having you talk over each other, first, Bruce, welcome to the show.
Well, thanks, Rachel. This is, we try to bring a lot of value to our listeners. And I think the most valuable things we do all the time is to bring guests on. And there's probably nobody that we have brought on that will resonate with our listeners more than David. Of course, we had Nelson on too, but now David has a unique perspective of how the Nelson Nash Institute will be going forward with since Nelson graduated from this earth. So I'm really excited for our listeners to listen to David, both of the past of how the Nelson Nash Institute was established and then his views going forward.
Absolutely. And before I fully introduce you, David, welcome to the show.
Thank you, Rachel. I appreciate it. Thanks for the invitation. I invited my friend back here to visit also. He's my chauffeur, quote unquote. So if I get something wrong, he lets me know about it. But it's great to see you again, Rachel. And of course, Bruce, you and I go way back, and it's great to see you. You're one of the best practitioners we've got going. So I want to do anything I can to support your effort to spread the word correctly.
Awesome. So we've already got some people hopping on live here. We've got Malik Day saying this will be an amazing interview. David is the man, so he knows about you. And somebody with a name of Dub Squared, probably not their actual name, says, hey, y'all. All right. So if you are interested in infinite banking, if you're wanting to know how to set up and use your infinite banking policies for the maximum advantage, today is a conversation you really want to tune into. So maybe you have decided infinite banking is something I'm going to do. You're already working with the right advisor. You have an excellently designed policy. Now you're sitting and thinking one day, how do I really become the best banker that I can and use my policy or policies to their fullest potential? So today with David Stearns, we're going to be unpacking the 5 rules of IBC. And what we're really excited about is that Nelson Nash started the infinite banking concept. We've been going through his book, Becoming Your Own Banker, in a series right now. But David Stearns has a front row seat to that experience, not only because he has married into the family, so he is Nelson Nash's son-in-law. He is also now the president of Infinite Banking Concepts, LLC. And so he's carrying on Nelson Nash's legacy really in 2 ways, personally and professionally. And so if you want to learn from the best, this is as close to the source as you can absolutely get. So come with your questions, pop them into the chat as we're going through this conversation today. And I'm going to say a little bit more about David just as we're getting started in case you're not familiar with him. So David Stearns is Nelson Nash's son-in-law. Nelson recruited David to help with the administrative side of Infinite Banking Concepts, LLC in June of 2004. And Nelson asked David to take over the company to continue the IBC legacy in 2009. David retired from the U.S. Army as a lieutenant colonel. He had served 27 years in the Army, first as a field artillery officer, then as an Army aviator. So you also had that flight experience. As with all military officers, he had a variety of assignments, including command, operations, safety, and systems analysis / operations research. David served throughout the continental U.S. and worldwide with a long tour in Egypt and multiple deployments to Germany, Korea, and Kuwait. Now, David is the president of Infinite Banking Concepts, LLC, which controls the distribution of Becoming Your Own Banker, the book that we've been unpacking, and Infinite Banking Concept materials, copyrights, and trademarks. IBC LLC manages the administrative activities of the Nelson Nash Institute, and he has been a director of the Nelson Nash Institute since the formation of that institute in 2013. So he's really at the head of the practitioners program as well, which we'll be talking about today. So David graduated from Buffalo State College in 1975 and received a Master's of Public Administration from Auburn University, Montgomery, in 1992. He's been married to Kimberly Nash Stearns since 1979. They live in Birmingham, Alabama. They have 4 children and 8 grandchildren. So I wanted to make sure that all that information was out there because it's so cool to see just a little bit of that history of how you are connected in with the story, but we'd rather hear more about it from you. So David, as we get started today, can you just kind of walk through What was it like getting started in this whole world of infinite banking?
Well, if I had to tell you what it was like in one word, I'd say painful.
Mm.
Painful because, when I met Nelson 2 days before I married his daughter. And so he didn't have much of an opportunity to find out if it was a good match or not. But the first thing that he did when we met was say, we have to have a conversation. And I thought it was going to be like, you got to treat my daughter well, whatever, the standard conversation between father-in-law and son. But the conversation was, sign this application for your insurance policy. And so, he was very direct about that. And he's always been direct about selling life insurance because he was totally convinced it was the best product on the planet, the permanent whole life product. And so anytime that we had a new kid, I got promoted, increased my salary, whatever it was, typically he would show up with an application, knowing that we could buy more. And so he kept pushing that envelope. And you talked about, talking about, the 5 principles of IBC. So pushing that envelope about buying more policies is, don't be afraid to capitalize. That's one of the critical precepts, but it's painful. You got if you're on a budget, on a salary, you increase, you got another $1,200, $1,500, $3,000 annual premium. Initially it's painful to do that, but like working out, if you're not stretching your muscles and destroying them to build them back up, then you're not really working out. It's the same thing with IBC. You have to, it's something that you really need somebody to hold you accountable, okay, for IBC, because you need a coach, you need somebody to make sure not only you're doing it right, but to keep pushing you to grow your policy portfolio and to use them correctly. So yeah, initially it was painful, okay, for me, but now, now that we're over the hump, quote unquote, and I don't have any debt, so I look for ways to put money in policies right now. Every time I get all our policies are annual premiums. We don't do monthly stuff. It's just annual because it's actually more efficient. And when I pay my premiums, I wait 24 hours and go back into the portals for these insurance companies and find out how much additional unscheduled POA I can jam in that policy. Some people think that, buy another policy, don't put additional premium in an existing policy. Well, okay, I'm not an insurance guy, so I don't know the nuances about that. But if I have a policy in force that's 20 or 30 years old, and I can put another $20,000 unscheduled POA in that policy, and it's sitting in a bank account somewhere, why wouldn't I do that? Okay, so that's, again, let's go back to the 5 principles. Don't be afraid to capitalize your system. Okay, initially it's going to be painful, but like anything else, once you generate that momentum, once you get on that growth spurt in these policies, which is something magnificent about it, the uninterrupted compounding entity like a whole life policy, then it becomes easier and easier to do that.
David, isn't it? I find it fun when I make premium payments, and people think it's weird that I find it fun, but I have a bunch of seasoned policies too, just like you do. I love it to make the premium payment and then check out how much my policy has actually grown by much greater than my premium payment. Now, it doesn't happen right away because you can't be afraid to capitalize. At the early part, there's going to be some lack of liquidity. But we on the Money Advantage use the analogy that banking is a business. And with any business, there's going to be a capitalization period to get your business rolling.
Right.
And so if you think of banking as a business, which it is, thinking that your individual bank is a business, which it is, then you have to understand that you're going to have to capitalize, but not all that capitalization is going to be liquid at the very beginning. Just like with any type of business, it's going to take a few years for you to show a profit. And so if a person takes that seriously, that they're building their own banking business, then they can get excited about the future and delaying gratification. So don't be afraid to capitalize is probably I think the greatest point out there. And unfortunately, a lot of people in the industry now think capitalization is not that important.
Well, I don't know if I don't know if you want to get into it or not, but there's a lot of creative, quote unquote, policy design experts out there and social media.
Yeah,
land.
let's go there.
Okay. And whether you're on YouTube or TikTok, okay, you can pick up a lot of good information, but you can pick up a lot of incredible information that has not been discussed or has been left off the podcast or whatever for some reason. Okay, so it's IBC is a process, it's a concept. Okay, and it's a banking concept, privatized banking concept, and you got to get that part right, and that part's easy. Okay, but unfortunately, the platform is the insurance policy. Okay, and I'm not talking about an index universal life policy, because we'll go into that later on if you want to. I'm not talking about that. I'm talking about the permanent whole life policy that's correctly designed for the policy owner. There's not one way to do it. Okay, but the policy owner is going, well, what's the correct design for me as a policy owner? Unfortunately, with YouTube and TikTok and Twitter and all these other social things out there, everybody thinks that the best policy design for them is one that provides them the greatest cash surrender value upon delivery of the policy.
Day one.
That's false.
Mm-hmm.
Okay, if I'm 85 years old and I have no beneficiaries and I want to get as much money in these policies as I can in 5 years or 10 years for some reason, okay, then that probably isn't going to work for me, a policy design like that. But if you think long range, and that's my number one precept, okay, and don't be afraid to capitalize as the number two one for me personally. If you understand what thinking long range is, what it means in the IBC world and the capitalization thing we just talked about, then a policy that delivers the maximum cash surrender value in day one is probably not going to work. Okay, because if I have a policy, like I said earlier, it's 20 years old and I pay my annual premium on it, and then once that premium is deposited and the policy's been renewed for another year, then it gives me the opportunity to put additional capital in that policy through the unscheduled PUA. A policy that's designed with a huge cash surrender value initially, you can't do that. Okay, number one, because there's no room in the policy, it'll mech. Number two is the real growth potential on whole life policies just comes from the base premium. Mm-hmm. Okay, long range growth, uninterrupted compounding comes from the base. And these PUAs are 1 year single premium policies that are kind of built on top of these things. And they're important and they're great. And Nelson was surprised how wonderful these things worked. And he said some things about them that I'll talk about later on. But if you understand what you need as an IBC client, what do you need? Do you want to build a policy where you can buy cars every 4 years, like Nelson discussed in the book? Do you want to buy a policy that you can retire on? Okay, or multiple policies. You have to understand what that's going to look like, for 20 years down the road, or 30 or 40. But you got to build something that's stable, number one, okay, that allows you to capitalize the thing more than the face value contract amount, number two. And number three, if you want to use it for banking, then you have to be able to overfund it through your payment schedule. Okay, so that way you can that's where you recapture, some of the interest. Okay, if you can't overfund that repayment schedule, i.e., in the book he talks about, you buy a car, the GMC says you pay $260 a month. Well, pay yourself $275. Okay, so that $15 a month, where does that go? Okay, it goes into growing the policy in the form of additional premium. Okay, an overfunded, lopsided policy, a 90-10, for example, you can't do that because it's razor thin. Okay, between the cash value of the death benefit and you have to be very careful. And also, if you look at one of these policies that looks really, really good that everybody wants, if you read the fine print, even though it's not a MEC when it's delivered, a modified endowment contract, there is points within that contract that says you'll have to decrease your premium payment in order to keep it from MECing. Well, you can't decrease the base premium because that's a contractual obligation. Okay, so the only premium you decrease is to pay up additional rider premium. So you got a tiny little base, i.e., you're not paying the insurance agent anything, but you get the max cash value in year one or day one even. But as you keep reducing that PUA in order to keep the policy from MECing, you end up with something with a small base premium, which is your engine that grows this thing, for years and years and years. And your PUA is shrinking, gradually shrinking without the capability of overfunding the policy in out years. Does that make sense?
Mm-hmm. Yeah.
Yeah, it makes.
Okay, and then those are also where you said there's the annually renewable term inside of there where you have the increasing cost usually to be able to support that.
Oh yeah, I haven't even talked about that yet. Yeah. Boy, I mean, that's fine. And the annual renewing term is handled differently by different insurance companies. Mm-hmm. Okay, some of them will shave your dividend to pay that increasing term premium. And you don't even know. It wouldn't
matter how much of a high illustrated dividend you show with that company if yours personally is getting reduced.
If it's being reduced by paying the term, I'm not saying a company does that or whatever, but I've seen that. Okay, so it's again, and so what's that doing? That is stealing the peas. Okay, number 3 on the principal list. Okay, so as I said at the start of this conversation, there is no one right policy. Okay, it depends upon what the policy owner needs and wants, how they're going to use it, and what are their expectations for that policy. And so, but if you follow the precepts, think long range. Okay, don't be afraid to capitalize. And then I just introduced don't steal the peas. Then you want a policy that you don't have to worry about every year about MECing, and you have to do some magic to it to keep it on straight. You want a policy that you can, if you have a windfall, you can get more money in there. Okay, if you can't, then you start a second policy. Okay, and you want a policy that your dividends are buying paid up additional insurance. That's a no-brainer. Okay, you don't want anything to impact that dividend, buying paid up additional insurance. You want that to be stable too. So that's how I look at it. Okay, and the 4th precept is don't do business with banks. Well, it's a no-brainer, but I have seen stuff out there that's kind of crazy. And it's another misnomer that we can talk about where people are actually using these policies as collateral for bank loans. Yeah. Okay. Or there's one guy out there on TikTok is teaching people to use a credit card to pay premiums. Okay. How
David, is that? if you, I don't know if you remember, but I actually sent you and Robert that particular TikTok, Instagram message, which was absolutely asinine, where he was actually advocating borrowing against your credit card to actually pay the premium and then use this told me right now this guy didn't know what was going on, because he said then you can just take the cash value and pay the credit card off right away. Well, even in a 90-10 situation, there's not going to be enough cash to pay the credit card off completely. So the guy obviously didn't know what he was actually doing. So no, David,
that is hurtful. Okay.
Yeah.
And it's going to send a lot of people over the top, and the guy never mentioned IBC. He talked about his infinite bank or his infinity bank or something like that.
Right.
But still, people, I guess the lesson there is, if it sounds too good to be true, it probably is too good to be true. Okay, so do your due diligence. Start with becoming your own banker. Take 4 hours to work through that book. Wow, it's 92 pages in length, and talk to somebody who knows what they're talking about with IBC. And if you have questions, if something doesn't make sense, then go to the website, find a practitioner, and ask them, I don't understand what's going on with page, 26.
Mm-hmm.
And you don't have to, pay people to do that, but get an opinion from somebody who's trained to understand what this is really all about. Somebody like Bruce. So I don't know,
Yeah,
because
I think it's fascinating that you're bringing up this, because I think as infinite banking gains popularity, there are a lot more people talking about it and then using similar words that sound like infinite banking. And then there can be a tremendous amount of confusion because, unfortunately, when you get in when you get on the social media platforms, usually the goal is get as many views as possible, get as high of a following as possible, get the highest ranking keywords as possible, ask the questions that everyone else is asking, and then try to do it better than everyone else. And so the things that are getting the attention often are almost misleading from the principles, the main fundamental core truths of how infinite banking actually works. And we've had to deal with a lot of that. But then at the same time, Bruce, you and I have had several conversations where it seems like people are also very hungry for the truth. I mean, it's kind of like even in Christianity, there's so many things that might feel like, well, this sounds really amazing. And I can, not have to go through any of the painful part of, repenting or thinking about sin, or I don't have to really be a good person. I just have to do this one tiny little thing and then everything's good. Well, it's not sustainable in your spiritual life. It's not sustainable in your financial life to do something that just seems way, way, way too good to be true. And I think people are hungry for things that last, for principles that work, for marketing strategies that are not just overnight successes and get rich quick schemes. I think many people are starting to see behind that and realize that it's very superficial and it doesn't last and it doesn't produce the fruit that they truly want in their life. And so I think this is a perfect time to be talking about the truth about infinite banking and sharing the stuff that might not be as glitzy and glamorous, but it really is the stuff that lasts.
Right. Yeah. And, I hate to talk insurance because, I'm not an insurance advisor. I'm not licensed to sell life insurance. I'm not contracted with any carriers. I look at this from a client perspective, from a consumer perspective. But whole life insurance is not glamorous. Okay, number one. Number two, it's hard work because you got to make the effort to build your portfolio over the years. Okay, and I'll tell you right now that I'm 3 policies behind, and I have no excuse for it except for I'm lazy, but. You gotta come up with a strategy. You gotta work towards an end goal, and there's nothing free out there. And life insurance is not a free deal. Okay, insurance companies have to make money to stay in business. They have to have these federally mandated reserves. They have to pay their agents, to sell their products at. But it's a 230-year-old product that's standard, that's been out there through the ups and downs, and like Nelson bought his first policy when he was 14 years old, okay, from New York Life, and his parents were the beneficiaries, and he was like his premium was like $11 a month or something, $10 a month or something like that. I showed those policies. I have them all. I showed them at the last think tank. And it's just like, you got to be kidding me. Why would a 14-year-old guy buy a policy, a New York Life policy, and have his parents as beneficiary? It's like, it's crazy. Then he bought another one 2 years later. And then when he got engaged to his wife, Mary, he bought a policy on her life, okay, before they got married. So he believed in that solid product set. Okay, and this is, IBC that didn't come around until like 1990, 1980s, 88 when he had his financial problems. But there's nothing glamorous about life insurance, especially whole life. But you're right, social media tries to make it this wonderful, product. What the important thing is the privatized banking aspect of it. Okay, if you want to get rid of your credit cards, get rid of your 17 or 22 or 25%, interest rates. If you want to eventually take over your home mortgage, if you direct all that interest back into an entity that you own, then you got to come up with a long range plan. You got to stick to it. Otherwise, you're not going to get there. Okay. One of the things that kind of bothers me about IBC, and this goes back before all the social media, is that the big focus was debt reduction for IBC. Okay. And the sales pitch was, okay, how much is your credit card debt that you have currently? Well, I have $10,000 in credit card debt. I'm servicing 3 credit cards at X number of dollars a month. Well, let me show you how you can design a policy and you can transfer that debt within the construct of the policy. Okay. And then you can, and eventually you can move all that debt into a policy construct. You can be servicing that debt through policy loan repayment, which is fantastic. But some of those individuals ended up with a policy with $10,000 in a policy loan obligation that they were servicing on a monthly basis. But after a year or two, guess what? Their 3 credit cards are maxed out again. And so now you're working on 2 sets of values there because they didn't understand the banking process and what this is all about. And you talked about Christianity and you talked about the fundamental truths behind that. Well, if you don't understand the truths behind how to manage your banking process, then you're probably going to waste your time. And what's going to happen if you have $10,000 in debt with credit card coupled with $10,000 debt on your life policy? Which one's going to go first? Well, the insurance company's not going to take your house or take your car or take whatever because there's no collateral in that debt. But the credit card certainly will. So that's the one you're going to focus on. So what typically happens? Those policies lapse. And
so David,
we just
talked about this on a previous podcast. And what's so hurtful about that is then all of a sudden people say, well, see, whole life insurance is a bad product. This IBC concept doesn't work. And yes, this debt reduction is or this velocity banking that people are trying to, use whole life insurance for really is not it's not the long-term thinking that we're trying to do as far as changing your money habits. Whether it's the arrival syndrome, you think you've got it all figured out now that all I have to do is do this. But people have to change the way that they view money. This is probably a good transition on how the infinite banking or the Infinite Banking LLC or the Nelson Nash Institute came to being. So could you kind of start from the beginning? You and I met in 2000, I think it was 2008 or 2009, from a night of clarity is where we were first got introduced with Robert and Carlos, and then they quickly introduced you to you and Nelson. But can you kind of talk about the evolution of the Nelson Nash Institute and then thus how the practitioners program came about and why the practitioners program came about?
Okay, yeah, good. Nelson believed in grace, okay? And he thought that that everybody should have IBC because it was a gift to everybody. Because it was the right thing to do. I mean, he despised qualified plans. He despised, the federal, government channeling everybody's money to Wall Street and select getting rich. And so he saw IBC as a way for people to get their money out of Wall Street, not invest in qualified plans, have the money locked up, blah, 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 and use it whenever they needed it on a private contractual basis between the individual and a mutual insurance company. Okay, so freedom. And he wanted to spread the word. And Nelson's joy was to do live seminars. And one year he did 50 of them. Okay, and I'm talking about an 85-year-old man who stands up for 10 hours straight. Okay, 2 hours on Friday night and 8 hours on Saturday, and teaches IBC to 5 people, 50 people, whatever was in the room. And that he would go, and people would have to raise their hands and say, can we stop and take a bathroom break? Because he was so passionate about it. But anyway, so somebody would sponsor him for a seminar, typically an insurance agent, because they wanted to, use him as a platform to sell life insurance. And he would gladly accept it. Of course, he got paid, and he'd fly out to wherever they were, and he'd do a seminar, and he'd meet with people, and he'd get to know the insurance agent that was doing it, and blah, blah, blah. And so the agent became, a friend and whatever. And nobody ever asked, what are they doing with this information? And over the years, I'd go with them on these seminars, and some of these guys were selling the wrong product set. Some guys and gals, some of them were designing they weren't doing it correctly. I don't know if it was intentional or if they just didn't understand what the deal was, or they would be a front person for somebody else who was doing the selling, and it was totally the wrong product set, and they stayed in the background. And so Carlos, Bob, and I, and Nelson said, we have to come up with a standard, a baseline standard for what this is about. And if Nelson's going to continue to do seminars, we have to hold the individual accountable for what they're going to sell off Nelson's genius. Okay. And so we created the practitioner program to create that population of financial professionals who would be offered the opportunity to use Nelson in a live environment. So that was number one. So it's okay, how do we do that? Okay, in the past, we worked with insurance agents to create kind of a training program for agencies, but it didn't ever work because those agents had their own idea about how to do stuff. And plus they wanted to co-opt the message. And it's like, no, this is Nelson's message. So we're not going to do that. So we decided, we call it the Infinite Banking Institute initially. Carlos, Bob, Nelson, and I decided we're going to create a educational program, strictly educational, that was not aligned with any insurance individual, that would teach the foundational truth of IBC, and link it to what we called Austrian economics, which is a whole nother 10-hour discussion about understanding what causes boom and bust cycles in the business world. How does the economics of life insurance really work? Stuff like that. So we're going to do that. And that would be the gate that agents would have to pass through in order to become an authorized IBC practitioner, to use Nelson, to use our products, our trademarks, or copyrights, or whatever. So that was the baseline of it. And Nelson had a population of 30 or 40 agents who were actively using him for seminars. And we said, everybody who wants to be an IBC practitioner needs to go through this program. And someone said, well, what about me? Nelson's already done 5 seminars for me. Why do I have to do it? Because we're starting from ground zero. Okay, fine. So that's when we started the program in February 2013. I think we enrolled 99 people.
Wow.
And then a year later, we decided that, well, this is supposed to be, we not only do we need to control, who's using Nelson personally, but we need to make sure that everybody understands, where the public needs to go to learn about IBC. A one-stop shop where they can go and they can get the materials, they can look at the videos, stuff like this, and they can find a financial professional, an agent, IBC practitioner. And so, Infinite Banking Institute, that sounded like something aligned with the Federal Reserve. As we said, what we really need to do is we need to provide an entity that people can find easily and that will honor Nelson's legacy. And so that's when we changed it to the Nelson Nash Institute. So there was no question about what it was. The word banking wasn't in there. It was about him, about his vision, about his genius, and his grace, and his, but sharing his message with the world. And it was, there's no hidden agenda. What you see is what you get. So that was the genesis of it and why we did it.
And as I recall, there's been a few, because I believe our organization was one of the first to actually get into the practitioners program. and go through it. There's been some evolution along the way. Can you talk a little bit about what's in the practitioners program? How many people actually sign up? How many people actually complete the practitioners program? How you can check out to see if a person is a practitioner, because that would be a great way for people that are looking at social media and they see a certain person, they could go see if that person is actually a practitioner and is actually following the Nelson Nash Institute guidelines.
Yeah, that's a good point. We have a listing of practitioners on the website, and our initial thought was, okay, we'll put this listing up there. So if somebody lives in Missouri and they hear about IBC through a podcast or whatever, they want to find somebody who's trained, they'll go to it and say, oh, okay, here's Bruce Weiner here, boom, I'll call him up, boom, But what ended up happening more often than that was folks would hear about IBC from somebody in social media land, and they would find out, they would go to my website and see if that person was on there. And if they weren't, then they'd contact us and say, hey, listen, is this individual part of your organization? And it's like, no, he's not. I can't verify if he's trained or not, but he's not been through our program. And so that happens more often than somebody looking for an agent. But, the Nelson Nash Institute, infinitebanking.org is the URL. And there's a practitioner finder database on that website. You can get to it from the homepage or the resource tab. And all you have to do is click on that. You'll get a map of the United States or a map of Canada. And you just click on your province or state, and you'll see a listing of individuals who are resident agents. And then below that, you'll have non-resident agents. And those individuals have been through our training program, number one. And number two, they've joined the Institute membership as practitioners. They pay an annual fee to be listed on there, to be invited to the think tank, to get it, have access to, different materials on their membership portal. By the way, we don't receive overrides from any production at all. Okay. We generate income from our training program, from membership dues, and, from selling books and stuff. That's it. Okay. And so that is a great resource. Going to the site and trying to validate if this person's been through the training program or not. You asked how many people have gone through the program and what it looks like now. We've changed it 3 or 4 times. We've added material to it. We've made the contract more restrictive. Okay, so we can terminate people easier that are doing the wrong thing. But I've said, we interview everybody who wants to be a practitioner. They submit an application. I do a phone interview with them, find out who they are, and then if they pass that, then I schedule them for a Zoom interview between Carlos, Bob, and I are in that interview. And then we spend an hour with them, and then we decide if we're going to offer membership or not membership, but enrollment in the course. And the second decision we look for is if that person is like-minded to us, i.e., for a libertarian Austrian, okay, believes in the product, wants to do business with an insurance company, not with the federal government, and they say all the right things, but they have limited experience in the insurance industry or limited experience in IBC, then we offer them enrollment with the requirement they have to work with an existing practitioner initially who will vet them and make sure they're doing it right. Okay. I mean, nobody's an expert on IBC, so we're not saying, okay, this person's got to work with them until the Nelson Nash reincarnated, but we just want to make sure they understand the fundamentals and are doing it correctly. Okay. And so those are the wickets we go through. And right now, I don't want to say any companies out there, but I get a lot of applications from different IMOs like World Financial Group, for example. And without throwing anybody under the bus, and say, listen, you sound like you're a great applicant, but that doesn't work with IBC because of different structural constraints within the organization. So you got to, look for somebody different. Or I'll do an interview with somebody before they get to the gambit, and I say, listen, you're really excited about it. You read the book 5 times. You just got your insurance license, but you really don't understand the industry. Okay, this is not about just because it sounds really good to you doesn't mean you can make a living doing this as an insurance agent. So I give them, a path to get on, and then so you get some experience first. So probably about half the people that submit an application get to the interview process, the formal interview process. And once they get there, probably, 95% are approved to enroll. And out of that 95%, probably 80% actually enroll. And, I don't know, what the difference is, why they don't. And then we have people who go through the course but never finish the course. So I don't understand that either. And then it's people that finish the course and work with a mentor, and they, whatever. So we typically have about 300 practitioners that are active, okay, in the United States and Canada, about 300. And there's probably like 150 that are somewhere in their students or mentee status floating around out there. And then a lot of folks decide that they do want to sell an IUL, or they do want to do these policy designs that are not congruent with what we teach. And so they elect to not to renew their membership, then go off and do their own thing. Okay, and that's fine. We're not above anybody else. We have certain standards that we uphold, and that's the bottom line. If you don't want to do what you got to do, then move on. It's a big planet out there. There's everybody needs to understand what this is about, and everybody needs to have an opportunity to do it. So the more, the better.
Well,
Yeah, thanks. Thanks for that. And the other thing, what I think reason that people don't follow through, David, is because you guys have done a great job of making this an extensive test of whether they really want to understand what's going on or not, and fixing the problem. And I've mentored people for the Institute, and all of a sudden, as I'm trying to educate them on how the policy design, how it works, and they just fall off the face of the earth. It's like, oh, I thought I was just going to be able to show somebody an illustration, and they just sign up. Well, that's not the way it works. Yeah. You actually have to help the person understand how that's going to benefit them and solve the problem of the financing in their lives. And people just aren't willing to do it. They just think it's some kind of lead generator that people are just going to say, oh, I want this so badly. Just give me the application and let's go. And so these people actually just fall off the mentor program because it's a lot of work. But then when you do have a practitioner that's gone through it, they're prepared. They can answer the questions. They can help a person along. That's the other thing that the 90-10 happens, is that they never talk about servicing the policy. Mm-hmm. They just want to get you into this the first year, and you never hear about how they're going to service it. Well, the reason is that they don't service it. They put it all on you to take care of it. Where in the practitioners program, you learn how to actually do annual reviews, actually how they actually will call you to set up a loan and a loan repayment schedule, and the kind of things that you should be understanding on your annual review, your annual statements, and so on and so forth. And a lot of people in the industry don't want to do that. They just want some shiny illustration to put in front of somebody and go from that. So that's why I thought it was real important to talk about how the practitioner program works. And Rachel, I know you had something.
Yeah, on that note, I think for the consumer, for the person who's looking for a true infinite banking policy, I think the practitioner program is very good at helping them understand and see who is going to match up with those priorities. I think if you are concerned that maybe I'm getting something that's not quite right, or it's not going to perform for the long term, or the policy design isn't quite right, or I'm not going to be serviced well, or the advisor might not really understand infinite banking the way that Nelson Nash intended it and that I really want to create in my life. If you have any of those questions, making sure that you're working with someone who is a practitioner is, I wouldn't say it's a 100% guarantee, but you're in a position of really knowing that this person's been vetted. They have the relationships, they have the education, the training, and they're willing to continue on with those fundamentals. And so I think that just gives a lot of certainty for the consumer who's really looking for that information. And then I love that you brought up the whole idea too, that a lot of advisors might say, oh, hey, look, there's a lot of money in infinite banking. Let me just go ahead and get certified so that I can be, more attractive. And then that's a marketing ploy, really. I'm now certified. And so now, because I'm certified, people will trust me more. Well, if the fit isn't right, that's something that you're not continuing on with that stamp of approval from the practitioner's program. So I really love that you're bringing full circle, just really this truth, the salt of the earth, the fundamentals, the reality of how infinite banking works. And you're really keeping it true to its original intent.
Yeah, that's the intent. Yeah. And some people call us old fashioned because we don't understand the new product set.
Whole life is pretty old fashioned, isn't it?
Yeah. But there is one thing that I was concerned about was if you're a true practitioner and you have, just say you have 200 clients, IBC practitioner professional, and you have 200 clients, if you're handling them correctly, how many more clients can you take on? And I don't know, Bruce, how many repeat offenders you have where you have a core client base and a lot of your business is additional policies.
Yeah,
from
absolutely.
Those policies, because you are coaching them, you're holding them accountable, and you're keeping them engaged, and so they understand the process. And somebody who leads with an illustration, walk, don't run, get out of Dodge. They don't know what they're talking about. Okay, if somebody contacts me and says I want to be a practitioner, what kind of software do you guys have? Hey. Why would I be concerned about software? If you're an insurance agent, if you're not an expert on your carrier's proprietary software, then why do you need something else? So that tells me you don't understand what's going on in your company set, number one. And number two is you're looking for a sales pitch. So, you're looking at the wrong place, because this is a successful practitioner is somebody who can look the client or the prospect in the eye and say, tell me what you know about IBC. Tell me what you think you know about IBC. What problems can this solve for you and your family? If they say, well, you're supposed to tell me that, then don't spend all your time reading the book to them. Okay. You need to make them take ownership of what the core problem is here. And that's banking. Okay, if they don't understand that, then that potential client probably is not going to be worth it. Okay, in the long run. So that's why we focus on education. And we did the program I told you earlier, and Robert Murphy, PhD economist, he was the guy that actually put the course together for us. We had all this material, and he just locked himself in a room and worked for a month and knocked it out, because the guy's a genius. Okay.
Yes, he is.
And he understands what we're doing, and he's fully vested in what we're doing as being part of the team. But IBC is freedom, is the bottom line. Okay. And if you do, I'm 69 years old, believe it or not. And I guess I'm going to have to mandatorily take Social Security next year. Okay. When I'm 70, that's going to be mandatory. I would rather to have the federal government not take my Social Security premiums from me and not even pay me, and let me use that source of income or source of payments to go into these policy constructs. I don't want it. I don't need it. Okay. But it's mandatory. It's directed. Qualified plans. I don't know. Again, that's another topic of conversation. But I talked about at the last think tank, about my dad, and I contrasted with some of his financial instruments he had with what Nelson was doing. And one of the things that I inherited from him, plus I have 4 siblings, everything was split 5 ways, was he had a mutual fund account set up. So I got 1/5 of that. Instead of cashing it in, I said, okay, I'm going to use this as a proof of principle. Since all I do is IBC, I don't have, anything else, IBC period, boom. So now I have this small little mutual fund. And every month I get my statement. It's like, boy, if this is all I had, I would be freaking out. Okay, so what kind of con job is this? Yeah, 5 years ago it was going the other way, right? But now it's going this way. It's like, okay, folks, wake up. Number 5 in the list of principles for IBC. We didn't talk about this. Number 5. What is it, Bruce?
Oh, I forgot what we already talked about. It's been so long ago.
We talked about think long range.
Don't be afraid to capitalize.
Right.
Don't steal the peas. Don't do business with banks.
Number 5, rethink your thinking.
Rethink your thinking. Yeah. I guess I need to rethink my thinking because I forgot that one on the spot there.
That was given to us by one of our practitioners about 6 years ago. And I mean, you always got to step back and think, what is really going on out there? Why do we have these plans where we're granted these deferred tax benefits? Okay, why don't we just put something in there that's outside the tax structure, and I don't have to worry about, death benefit, non-taxable, cash surrender, non-taxable, unless you exceed your cost basis, dividend payouts, non-taxable. Okay. Transfer ownership of policy, no tax implied there, whether it be absolute assignment or ownership transfer. I mean, this is all freedom. Okay. And it's
loans aren't taxable.
Loans aren't taxable. Like I said earlier, there's no collateral. Okay. The policy is the collateral so that your house or car will not be repossessed. It's freedom. Okay. So that's why Nelson said it's not about interest rates. Okay. That's not important. So what if you can get a car for 0% from the GMAC dealership loan? Pay 5% and own it outright without having to worry about any of that stuff. Okay. Plus, if again, just go back an hour, construct the policy correctly, pay your loans back on a methodical basis, and construct the repayment schedule back so you can pay it off early, redirect additional payments into your PUA. Okay. So you can grow the policy on top of paying the vehicles back or whatever. It's about freedom. Okay. So that's the bottom line.
Yeah, it's interesting you mentioned that because during these low interest rate environments, I would get people that say, well, why would I borrow against my policy when I can get a 3.9%, from the dealership, and I'm going to have to pay 5% to the insurance company? And first of all, no matter how much you try to rethink their thinking, it's so ingrained in us as an American society to focus on interest rates. And I would I wouldn't try to do the math with them and try to talk about how, well, yes, but if you're capitalizing, you're actually making money over here compounded. Who cares if you're paying a little, interest to the company? The most important thing is you control the banking process. So if you need to change your loan, you can change your loan payment. Whether it means reduce it, stop it for a little bit, so on and so forth. You can't do that with a bank. You can't say, oh, by the way, we had a little extra this month and when we'd like to reduce our payment from $500 to $400 this month. They'll laugh at you. David, you mentioned this briefly earlier about how people were assigning their policies to banks to get collateral assignment so they could get a lower interest rate. And I actually had 2 clients that did that, and both of them regretted it because what ended up happening was they didn't read the fine print, and they could pay it off and get that release of collateral because the interest rate was variable, so it went over what the insurance companies were actually charging. So they wanted to get their policy back. Well, they told the bank, I'd like to, pay off my policy, and they said, or my loan to get my policy back to myself. And they said, well, that's fine, pay it off. Well, they go, but we need the cash value to pay it off. So you have to release it so we can get the cash value. And the banks are like, well, we're not going to release it because that's the collateral. So they were stuck. they had to come up with the cash from somewhere else to be able to release it.
Yeah.
So this is the lack of freedom that you're talking about.
Yeah.
So one of the things I think I want people to understand is that the Nelson Nash Institute was not set up for insurance agents. It was set up for the general public.
Mm-hmm.
The practitioners program was set up for the insurance professionals. So can you talk about some of the resources that are on the Nelson Nash Institute website that the general public can actually purchase for themselves?
Well, I mean, they can buy materials, but a lot of stuff's free also. We have a store. We sell, Nelson's book, Become Your Own Banker, second book, Build Your Wealth of Wealth, other books and materials and DVDs and this and that. So it's, all that's there for the public. And there's like, we have a video series we did back in COVID days called Foundations of IBC video series. There's like 12 parts. The first, I think 4 or 5 videos are free to the public. And if you want to view the rest of them, you can either pay a whopping $49.95, or you can call up Bruce and ask him for a code, and he'll let you, give it to you, and you can watch them all for free. So those videos are a good resource in my mind for IBC, because again, we stick with the basics. There's no creative, magic about them. Also, there's, we do the bank notes, which is a little monthly newsletter I do. And it used to be all kinds of information there when Nelson was around, all kinds of Austrian stuff. But I've cut it back, and all I do is have 1 or 2 articles, and it's all focused on IBC. And most of them are either stuff by Carlos or Bob. Okay, so that's a freebie. They can get that on a monthly prescription. We have articles posted. A lot of the stuff that Bob and Carlos have written in the past are posted on there that are all very pointed towards IBC, pointed towards banking, pointed towards things that are really critically important to be successful in our world, our privatized banking world. So the site and the Institute, like you said, our focus is the consumer. We want to protect the consumer. We want them to do their own deep dive. Okay, and your deep dive isn't watching videos for 5 hours on YouTube. Their deep dive is to actually do some reading and do some research. Okay, and so that's our focus, and we're thinking about evolving and changing how we're doing business, but that's something that's just going to be a teaser I'm going to put out there about how we can get our practitioners more involved in what we're doing as an institute and moving forward. So that's something we're thinking about. We're also getting ready to publish another book. That's another teaser. It'll probably come out in 2023. Hopefully we'll have advanced copies for think tank participants, but that's another wish that I have. So
that's awesome.
Well,
That's awesome.
can we so I'd like to kind of wrap up the podcast with
I have a question before we wrap up, but it's about like the long-term and more generational thinking. Do you want to cover what you have first, or do you want me to ask about this first?
Yeah, why don't you start with yours first?
Okay.
Yeah.
So you had mentioned having something that works great later on. This was kind of when you were talking about the 1090 policy design, where people are getting too creative and thinking about, well, how can I have the most cash value right after I fund the policy? And this really goes along with the whole first rule of infinite banking, to think long range. And I think many people can wrap their mind around the idea of, well, I can think long range, maybe 10 years, 20 years. I can think long range to the end of my lifetime. But I think one of the greatest benefits of infinite banking is the generational component of being able to create generational wealth, where you have policies that are then paying out a death benefit into the next generation. And somehow you have within your legal guidance, or you've trained the next generation on the value of infinite banking, and they're using those proceeds to buy additional policies. And so can you just share your perspective on that? And especially as you then were receiving some, proceeds from Nelson Nash, as he had this focus and this eye towards infinite banking. He wasn't just thinking about the end of his life. He was thinking generationally. So how can you just share from your personal experience on that?
That is my generational wealth is my wheelhouse personally. I know that there's a lot of business owners that have a different mindset, but that for me, that's what's important. And when I say passing, when I think about passing wealth to the next generation, I'm not talking about a death benefit when I die. I'm talking about passing active, vibrant, mature policies to the next generation. And then the next generation after that. So we think 3 generations ahead. Like I haven't bought a policy on myself since 2004. I think it was the last one I got for myself. Maybe it was later than that. Maybe I can check it. But anyway, all the policies I buy are on grandchildren. And when you gave me your bio, we're actually up to number 9 now. But so the idea is to buy policies on grandchildren that are funded by me. And my hope is that their parents will buy a policy also. And then, I'm, like I said, I'm 69, and if I buy a L121 on a 1-month-old baby, do you think I'm going to be around to do anything with that? So the idea, from my perspective, is going back to a bank. Okay, going back to capitalizing a bank, going back to uninterrupted compounding, going back to a stable base premium. I buy, like I said, an L121, just say $2,000 to $5,000 annual premium on a newborn. After I fund it for 20 years, I pass ownership to the child's parents. Okay, the parents now are obligated to continue funding the policy. And I might have used it in the past. I might not have used the policy, i.e. policy loans. It goes to the parents in the transfer of ownership to the parents. Okay, it's private. Okay, now the parents have a policy on their 20-year-old son or daughter who is probably in college. I don't know where they're at, whatever. And the policy is humming along beautifully. Okay, so they fund it as long as they want to, and eventually they give it to the child. Okay, when the child is maybe 40, I don't know. And so now you have a 40-year-old whole life policy that's probably worth, 5 times more than the face value when it was issued. So that's generational wealth transfer. By the way, like you suggested earlier, Rachel, that policy's got enough cash surrender value where you can fund multiple policy premiums out of that if you want to. It's a seed that will create more trees, and you can build a huge portfolio of policies. One word I didn't say before was system of policies. Nelson never said this is about one policy. That's another misnomer about 90-10. You buy one, you're good to go. Okay. No, it's a system of policies. You're grown painfully, as I said before, and you provide those seeds for future generations so they don't have to go through the same pain that the first generation went through to do this. And that's how it works. In my mind, it's a generational wealth transfer. Nelson talks about it in the book also. But that's, lifestyle is a piece of cake once you get over that hump.
I love hearing about that long-term perspective. I mean, I've been at this way less time than you, and I think our first policy was in 2011. So we're right over the 10-year mark. We have a second policy now. We probably could have had additional policies in the meantime, but we're putting a big chunk of our income into policies, and we're loving that, seeing the cash value increase. We're loving seeing not just when you first fund it, but then incrementally over the months as the dividends are working and the interest is working inside the policy. And it's really exciting to hear about the long-term vision, which does take time to build, and nothing grows overnight. It's something that you have to work at through a lifetime, which, if you're listening and you're just getting started, I'd like you to hear that here's what's possible. It's going to take time to build to that, but it's very exciting when you're being able to stand from your perspective, David, and look at the fruit that's been built before in previous generations from you. And now you're building, from Nelson to your grandchildren, that's already a 4-generation span that this legacy is working in your family. And that's just beautiful.
It is. And going back to the coaching aspect of it, you can't just go out and buy a massive policy on a grandchild. unless the conditions are set that allow you to do that. And that's where Bruce comes in. Okay.
Mm-hmm.
So ask him what I'm talking about.
Yeah, I talk about this with our clients all the time. And David, you are right. There's only a finite amount of policies that any one practitioner can take care of. And a lot of our new policies do come from the current policyholders. Matter of fact, Wesley Smith, who's been on the Money Advantage, he's on the podcast. One of our clients recently, emailed me and said, okay, I'm ready. I have more money coming in. I want to get one on my wife now. And he already has them on his 2 children. And so, yes, we get those kind of things all the time. It's funny, Rachel, this was actually where I was going to make sure.
Wow. Oh, that's
generational
so cool,
planning. Yeah. So one of the things, David, several years ago at the think tank, I did a talk called How to Make Infinite Banking Infinite. And this next part that I want to talk to is kind of really talking more to the financial professionals that listen to our podcast. Is there is only a finite amount of people that you can have the right customer service with if you're a rugged individualist. Mm-hmm. If you get with the correct team that has the customer service parts in place, because as we all know, home office can only do so much with customer service. They don't even understand, the customer service people don't even understand what IBC is. So when people call in and say, oh, I'd like to get a loan on my IBC, policy, that's not even vernacular that they use. So setting up your organization to actually handle as many as possible helps this generational planning. So I thought one of the greatest stories that I have heard, it's kind of a humorous story, David, if you don't mind talking about it. I know from listening to you on James' podcast recently, you don't really have any loans out right now. But as Nelson often said, opportunities find cash. So eventually you probably find some reason to take a loan out. But can you talk about the time when Nelson approached you while he was still living and he wanted to talk to you about if you had any loans with your policy and how they were going to take care of it so you had no more loans. So I thought that was a great little story you told at the think tank a few years ago.
Yeah, that's this is kind of contra to Don't Steal the Peas. Okay,
but I wanted people to hear this because we're all human. We all have to have people that hold us accountable. So this is great.
I appreciate you bringing that up because that's one of my favorite stories. I just don't want to wear it out. But the house I'm living in now, my home office, the house here, this is a beautiful place. We bought it from Nelson Nash and Mary, his wife. My wife grew up here in this place, and we lived a couple miles down the street. And Nelson finally came over. Kim said, "Yeah, if you ever sell the house, we want to buy it." And it's like the place was. It was different, okay. But anyway, so finally said, "Hey, listen, I'm getting old. I'm having a hard time managing the property. We're going to move into a garden house. You just don't want the house. Let's sell it to you." It's like, uh-oh. And so anyway, so we ended up buying the house, and I told Nelson, I said, "Listen, I love you, but I don't love the house. So understand that if we buy it from you, we're gonna make some major modifications." And he said, "Okay, fine." The bottom line is, we ended up borrowing about $500,000 from our policy portfolio to tear down and rebuild the house. And we did it through, I want to say construction loans, even though they weren't a construction loan kind of setup. But I get an invoice from the builder every 2 weeks for about $20,000, something like that. And so I had a thing going here. Every 2 weeks, I do a $20,000 loan from, I try to keep it in as few policies as I could just to manage it. But, over the course of time, we're about $500,000. And then, so we finished the house in 2011 and we moved into it in April 2011. I don't know if you remember or not, but that's when all those huge tornadoes came through here in April of 11. One went through Tuscaloosa and they killed over 200 people in Alabama. And the house we were living in. Is that the
Mobile, Alabama one too?
No, this is up north. This went through Tuscaloosa, then went through Birmingham. There's about 2 or 3 went through in the morning at 5:30, and then a couple went through later on that afternoon.
Mm.
Anyway, my existing house we were living in was not damaged, but we lost power. And what I was thinking was, oh no, I just, this house I'm in now was, done, but we still hadn't taken possession of it yet. And I'm thinking, so I drove down here in a panic, hoping that there was not a tree laying on top of it, but the house was perfect and it had power. And so the place I was in, no power, no water, no nothing. So we did a quick thing, moved all our, stuff over here, beds and stuff like that. But we moved in here. Anyway, we moved in here in April of 11. And I did not have a monthly schedule for paying back the mortgage, the quote unquote private mortgage on the house. I didn't do that. All I did was I do big cash dumps, 20,000 here, 50,000 there. And one day back in, I guess it was 2017, Nelson walked in here. He come over here every day. We sit here every day in the morning for 2 hours and drink coffee. And he was just hammering me all the time about, ask me questions, or I'd ask him a question and he would never answer it. And it was like, okay, you need to find out the answer yourself. Anyway, we had these discussions and whatnot. So one day he walks in here and says, okay, I got a question for you. And I said, okay, IBC question. No, it was like, how big is your outstanding loan portfolio? It's like, oh no, I have not been a good steward of IBC and I still owe about $500,000. So I said, oh no, if I tell him, I get mad at me because I haven't been servicing these loans like I should. And I said, oh, about $500,000. And he goes, good. And all he said was good. And he walked out, he left. And I'm going, what was that about? And then we started talking about it later on. He said, listen, you need a place for a windfall. I said, well, what do you mean? I said, he goes, anybody who gets a windfall, whether it's a lottery jackpot or a death benefit or whatever, if they don't have a place to park that money, they're going to blow it. And he liked the term blow it. And he's right. You look at all these professional sports people that have these massive contracts, and like 5 or 10 years later, they're bankrupt, right? Mm-hmm. And he goes, you need a place for windfalls. And at 500K, that's a good number for you. And so what he was talking about was my wife actually owned a couple of policies on Nelson, and he was planning his passing. And he was looking at all the stuff he owned and all the stuff that Mary owned. And he was trying to figure out, obviously he knew who the beneficiaries were and what the percentage of the death benefit were and stuff like that. But he was trying to protect us so that we wouldn't, do something that we would regret. And so I guess if we talked about, the 5 principles, that 6th principle is be prepared for windfalls. Because I'll tell you right now, if you're a practicing IBC person, you're going to have them. Okay. And the best place to put a windfall is in a policy construct. Whether you're buying a new policy, you're overfunding existing policies, or you're filling up loan holes. Okay. Prepare for that and plan for that.
Yeah. So don't seal the peace. Don't seal the peace comes into, several iterations. One of it is having an amortization schedule that we talk about with our clients. Okay. So it's especially with things that you normally would have an amortization schedule for, like a car loan. But then we also talk about windfalls. Like a couple of years ago, I sold one of my rental properties. I've told this story on the podcast before, and I had $110,000 windfall. Well, it just so happened that I was able to take that $110,000 and then pay off all my loans in my policies. And so if you understand that you may have a windfall from some kind of investment that you've made outside the policy, that is another way to pay off the policy. And then finally, the generational planning that you just talked about, and Rachel's about to release her legacy program. That is part of generational planning, is where does part or all of the death benefit go to the next generation? So I thought that was a good way to kind of wrap up all the aspects of infinite banking in this podcast again. And David, I want to thank you personally for taking the time and coming on. You've been a great friend over the years, and I've gotten a lot out of Nelson and your experiences. And we want to continue to grow the Nelson Nash Institute in the right way with the right people. And I'm looking forward to this year's think tank.
Great. I appreciate that. Thanks very much. I do look forward to the event every year. Look forward to your participation and the rest of your group. You've been solid practitioners, and as you said, you're a mentor for us. Okay, if I have somebody who needs help and you're interested in taking them on, one of the guys I go to, so that speaks a lot for what we think about you also. So,
well,
anyway,
David,
I enjoyed it, Rachel.
Yeah, this has been really good. I love how you covered so many aspects, but it's not just from the typical viewpoint. It's not just from an advisor perspective. It's really from caring, not just about your personal financial life and how you've put so much into IBC, but also just really caring about how infinite banking is used and how people truly can benefit from this beautiful, old-fashioned, non-flashy product that over time just does tremendous benefits. And you said it has a growth spurt of uninterrupted compounding. And I just loved how you said that. I mean, that's the exponential growth curve. And anyone who's experienced that in any way recognizes the beauty of that uninterrupted compound growth. And if you have multiple places that you are now maturing these policies, you are in a position of having that growth spurt truly happen.
Yep. And it's one of the 8 wonders of the world, and everybody's forgotten about it, unfortunately, because of all kinds of shenanigans.
Well, because nobody gets uninterrupted compound growth. They get it for a month in their savings account, and then they use the money, or 2 years in the savings account, and then they use the money. And the problem is nobody holds cash long term, but with infinite banking, you have the ability to hold this cash inside of your policy, keep the uninterrupted growth, all the while you're using it as well at the same time. And that's just unheard of in so many places.
Well, I'm sorry. One of the topics you guys need to talk about is it IBC / whole life insurance is inflation proof. I don't know if you've gone there or not, but you need to explore that if you haven't.
Well, what's interesting, Rachel, before we wrap up, and I just want to make sure we do wrap up, but because we're here for our listeners had 2 questions today that I want to briefly get to before we wrap up. And one, David, coincidentally, is about the inflation. So the first one was about the PUAs and will it affect the MEC status? First of all, there is the Treasury Department or the IRS MEC laws, but then each individual insurance company also has their interpretation of the MEC, not the law so much, but how they want to actually apply the premiums to certain base or term or PUA, so that they don't want to ever come close to those MEC limits. Now, some companies actually get closer to those MEC limits. And what he was asking is how can that possibly affect? Well, there are some companies that actually use a blended PUA term blend, and they actually have the PUAs from the dividends that are purchased buy out the term every year. And if the dividend doesn't actually perform the way they thought, it may not buy out as much of the term, and thus you could actually give what one practitioner once called as a dividend call. In other words, the dividend wasn't great enough and it didn't buy out enough of the term. So you actually have to put more in it to actually get the same results, or it may not buy enough insurance so that you would actually MEC the policy if you put more into it. So that's something that you have to work with a practitioner to determine. The great thing that most insurance companies nowadays will not allow you to put too much money into it. They will actually contact you or the practitioner or the insurance agent and say, we really don't want to accept this money. But there are companies out there that still will do it. So you have to make sure of it. And then the final one, Jonathan Ratliff said, my company, and this is about the inflation, David, my company just announced an interest rate effective January 1st, but was expected given the rates going up. So this is a big topic. So Several companies have announced interest rates for the loans. Now, those are tied normally to the Moody Bond Index. And as the interest rates have gone up in the Moody Bond Index, then borrowing costs from the insurance company will also go up. The great part about this, though, is that now the portfolio at the insurance company is also making more money. So, like we just found out from the insurance company we use most, that yes, they're going from 5% to 5.7% for the borrowing cost. But remember, you're part of the owners of the company, so you're going to reap that additional benefit. But they also are making 6.5% on their portfolio, their investment portfolio now. So historically, what will happen is there's always a drag. The loan interest actually goes up first, and then the next year or two, the dividend interest goes up and it will follow. So there will always be an arbitrage where the dividends will be paying more than the loan interest rate. And that's where the inflation comes in, hedge against inflation, because the dividends then will start to keep up, or in some cases outpace inflation going forward. Because why is it outpacing inflation? Because it's tax-free growth rather than taxable growth in the fruit. Well, technically it's tax-deferred growth, but you can access it tax-free. So you can overcome that. So all those questions kind of answered both of those.
Yeah.
Go ahead, David.
Back in the day, I know we want to wrap this up, but I mean, you look at some of the illustrations that Nelson put in BYOB from 2000. You can't ever get close to that nowadays, simply because of the interest rates. Mm-hmm. Okay, both the loan rate and also the dividend scale. Okay, but you're right. If the Feds would let the interest rate realign itself to a natural rate instead of a forced rate, then these companies would make a lot more on their portfolios, like you said, and the actual your IBC policy would perform better than it's illustrated. Mm-hmm. And another, Nelson talked about his State Farm policy a million times. I'm sure you guys talked about that in your course lessons thing. Okay, that policy, the face amount in that policy was $20,000. Okay. When his wife received the death benefit, it was $137,000. If you apply the 5 factor, it's even higher than that. Okay, so and that Nelson used that policy to buy stuff. Okay, and that policy didn't even have a PUA rider on it. Okay, it was just a dividend buying paid up additional insurance. So you're right there. These things are bulletproof if the company is a solid mutual holding company or whatever, and is managed properly, so.
And they've proven they can manage it for 230 years. So I think they have a pretty good track record.
Yep. They don't pay their CEOs $20 million is one of the reasons.
No, they don't.
Which is why it's really important not just to make all your decisions based on the interest rate the insurance company charges and the illustration for what the illustrated dividend is this year. I mean, there's just so many things that we could even unpack from here.
Thanks, Rachel, because I want to also tell people, remember, the declared dividend rate really doesn't mean anything because there's no industry standards to that either. So some of it's a gross, some of it's net, some of it's actually somewhere in between. So don't get caught up on declared dividend rates too, because there's no industry standard for that. And we hear this all the time. People say, well, why would I go with this company? Their dividend is less than. And we're like, that's, you have to understand that it's a proprietary thing. They don't tell you how they declare it. They don't tell you how they apply it. And I use this all the time. Coca-Cola doesn't tell you how they came to their dividend either. So it's not like they're trying to be secretive. It's proprietary.
Mm-hmm.
Yeah.
Oh, absolutely. Yeah. And Jonathan Ratliff just had another comment. He's a practitioner. I don't know if a practitioner, he's an advisor at least. I love it when doing a review with a client on whole life that we placed some years ago. The growth has been even beyond the in-force illustration tendered with policy delivery. And I think I mean, this all comes back to, we say something at the very end, which I'm going to bring up in the show right now. We say success leaves clues and follow the successful few. What's interesting is if you look at anyone who's held whole life policies for their lifespan, you're probably not going to see people who are significantly disappointed with the results. And so I think that's just one of the beautiful things about talking to somebody who's been using infinite banking for so long in their life. So David, this has been really wonderful having you on. I think we could have still talked for several more hours, and maybe we'll just have to have you back in the future. If anyone wants to find you specifically or find your work, I mean, we definitely need to direct people to infinitebanking.org. You mentioned all the books, all the resources, all the materials, and I just really want to thank you. Is there anything that you would say, David, as we wrap up today? Any last words that you'd like to share?
No, I just appreciate being on. It's always, sometimes I don't come from a script. I just try to keep it real. And I guess I should make it more of an effort to get out there. But my concern is that IBC will be destroyed, okay, if enough people misrepresent what it is and promise things that cannot be achieved, okay. And I don't, if you don't use a practitioner, that's fine. Just make sure, if you're a general public prospect or even a client of somebody, it's incumbent upon the policy owner to understand what this is about and how to properly use these instruments, because they're like a loaded gun. Okay, if you're not trained how to use it, then you can be very destructive with them. So,
thank you. We have Nicole commenting as well. Thank you for offering this powerful information. I'd really love to get my 3 sons who are in their 20s get started with their own policies. So just a lot of engagement today. Thank you everyone who's listened who's tuned in for even a brief period. If you're listening now, know that you can go back once we are finished with the live stream. You can go back and watch the whole episode. It will still be available completely for you on YouTube and Facebook and LinkedIn and wherever you are watching this right now. Please comment, please share your questions either in the comment section, or you can email them to us at hello@themoneyadvantage.com. You can also reach out to us directly at themoneyadvantage.com. You can book a conversation with an advisor and really find out how you can continue on or begin your infinite banking journey and design a system of policies for you. So David, just thank you for your evangelism of this message, but just really in a practical and grassroots way. I just really appreciate the fundamentals that are so strong through the practitioner program and through everything that we've ever seen produced through Nelson Nash. And we definitely are loving being able to continue on that legacy for ourselves and for our clients.
Okay. Take care. Enjoy it.
Awesome. Well, in closing, please remember success leaves clues. So model the successful few, not the crowd, and build a life and a business that you love. We'll see you next time.